Repo rate unchanged at 6.25%. We were talking about a 25 or a 50. The RBI has left the repo rate unchanged. Is it global factors that is leading to this? Supriya will join us any moment. But this is the big breaking news. Maithili, are you surprised?
Well, it just shows that the MPC members have remained the true conservative as they are expected to be. MPC members' monetary policy always is conservative. So they've looked through the impact of demonetization.
Maithili, please excuse me, but Supriya is waiting by. I think she has the details. Supriya, let me get across to you.
It's actually quite shocking because it looks like, and like Maithili started off by saying, Maithili, I'm sorry I'm getting in here, but it is completely unchanged. There has been no policy cut. It's a very conservative monetary policy committee, it seems, because they see upside risks to inflation. The headline from here, though, is that due to the demonetization exercise, they see growth being revised downwards. 7.6% was their previous target of GVA for fiscal year 17. That has been revised down to 7.1%, and I think that's the really big headline of this place. Apart from the fact that RBI has chosen to be very conservative, they say it's going to be an accommodative stance, but they see upside risks to inflation. Important to point out here, they believe that the OPEC crude prices capping production of that will firm up, and so that is one upside risk. They also believe that the base effect is expected to reverse and in turn turn unfavorable in the months from December in February and December. Winter moderation in food prices does not materialize due to disruptions. They believe some of the stance that they have taken due to demonetization is going to actually play out by the headline inflation projected at 10%, 5% coming down by 10 to 15 basis points in Q3, but they see the overall trend reversing. So there are three big headlines out of here. No action whatsoever on rates at all. They've chosen to stick to key policy rates, the repo rate at 6.25%, and so does the reverse repo, and everything stays. This is also very mum and very silent on liquidity measures. How are they looking to mop up the liquidity that is parked with banks due to demonetization? But the other big headline out of here, and I think we should get our guests to talk about this, is growth concerns, growth pangs. This is the first official estimate that's coming in from policy corridors, and RBI believes that the withdrawal of notes or the demonetization drive is going to push down growth from 7.6% as they had previously envisaged to 7.1% for this fiscal year.
Yes, Supriya, this is the clear headline of this hour, and we'll keep coming back to you for more details. Of course, the press conference is likely to begin in about less than 10 minutes from now. But just adding to what Supriya pointed out, the committee felt that the assessment is clouded by the still unfolding effects of the withdrawal of specified bank notes. And that just, I think, lays it out as clearly as it does, Maithili, that, you know, they needed to take some more time to assess the situation. Rate cuts can come by, but right now what's more important is liquidity management and to restore normalcy in the economy.
Well, absolutely. There are two ways of looking at it, as always in economics. On the one hand, you can say, yes, the MPC has been very conservative and they've not given you an upside or either on growth, as also on interest rate, they've kept it unchanged. But the plus is it shows an extraordinary degree of independence. And this is the whole idea of moving to the MPC, that you cannot browbeat 6 people, 5 wise men and one wise woman. You cannot browbeat them. So they felt the demonetization effect was temporary. They chose to look through it, see it as transient, and they've stuck to their guns. So the plus side is that we've got independence. Whether that helps us or not in the longer run, it remains to be seen. So you can't have it both ways. Either you have an obedient poodle at the Reserve Bank of India who does whatever the government wants it to do, and then you might find a rate cut, or you might find the MPC showing independence and keeping rates exactly where they are, looking through the short term, the friction, and preferring to go by the medium to long term. So clearly you can't have it both ways. So you win some, lose some. So you won monetary independence, we've got regulatory independence, and then you have the flip side of rates being kept unchanged because the MPC opted to look through these short term effects.
Okay. We've got a corporate voice, Mr. K.K. Mistry Johnson right now of HDFC. Mr. Mistry, are you surprised the rates have been left unchanged?
Yeah, I know. To be honest, a little surprised because I would have certainly expected a 25 basis points cut and maybe even a 50 bips cut. But therefore a little surprised. But I think what the RBI may have kept in mind may be a couple of things. One is they would have a much better control, a much better view on what's happening on the inflationary front than what we have, number one. And number two, I think they would also take into account the fact that Fed will almost certainly increase rates now in December. And then when when Fed is increasing rates, we would be reducing rates, which then could put some pressure on the currency. So, and that which could then have an inflationary effect. So I think these are a couple of things to keep in mind. But in my view, I still think that they have room to cut rates in
That's right, Mr. Mistry, and they haven't ruled that out. They're saying the policy continues to remain accommodative. But right now, there are challenges on growth, and they are also saying that there is some risks to inflation tilting to the upside, projecting CPI at 5% for Q4.
See, one way to look at it is that if RBI has some ammunition to do, let's say, 50 basis points cut in rates, getting the rate cut done today or making the rate cut today may not necessarily have resulted in anything. So they may be just storing that ammunition up their sleeve and use it on some other day. See, why would they do a rate cut? You do a rate cut either if you believe that it's going to push consumption forward because people will borrow more money and then use that for consumption, or you believe that people will use that, or that the rate cut will facilitate investments. The way I see it is that the capacity utilization in India still hasn't gone to the level one would like to see before you see a big thrust on investment. So that in that sense, cutting rates now may not have helped. So I think this fact, coupled with the fact that Fed is going to increase rates and maybe even inflationary pressures which they foresee, may be the three factors which may have kept them away from cutting.
Great. Mr. Mistry, I know you have a busy schedule. Leave it at that. Thank you so much, sir, for taking the time out and joining us and giving us that perspective. Okay. The other big headline is, of course, that the incremental CRR limits have been withdrawn. We return back to normalcy, something that Anant was saying. But just before I get back to Nilesh Shah and Anant Narayan, Supriya, I think you have some more highlights that you would want to share.
No, I just think, I want our guests to answer the questions that why is it so silent on the liquidity mopping measures, and I also think it's a little too premature to talk about that, but the fact that RBI sees upside risks to inflation, on account of what? Because they're also self-admitting that demand will be contracted. On one hand, they see upside risks to inflation, and on the other, they're cutting growth targets from 7.6 to 7.1%, essentially saying that consumption will be cut. Q3, the growth momentum will be lost. There will be waning effects in Q4. This is really contradictory speak, if I may, both to Maithili and to our guests here, because you have cut growth target, and I think it's important to harp on that figure because this is the first admission that's coming in from policy corridors that the demonetization exercise is going to take a toll on growth. It is going to lower growth from 7.6% as was being pointed out by the RBI earlier. In fact, I think the previous policy stance was 7.7 for Q3, and that has gone down now for the entire year to 7.1%. I think growth pangs persist. It's important to get our guests on that because these are two contradictory things that the RBI seems to be saying here right now.
So let's ask this to Nilesh. Nilesh, your initial thoughts on the policy, but this point as well. Is it global factors that are leading the RBI to believe that there could be upside risk to inflation when they in fact have cut the growth targets by at least 60 bips?
Clearly, there is a disappointment from the market reaction point of view because they had priced in 25 basis point rate cut. Now, we'll have to see RBI's language and explanation, but clearly what market would have loved to listen to, that liquidity will be adequate. They had talked about that on 5th April credit policy, where they said that now liquidity will be up to neutral level rather than plus or minus 1%. Now, withdrawal of CRR is a positive thing, but still market would have loved an explicit statement on liquidity. Second, on the inflation side, we are seeing consumption destruction happening. We are seeing wholesale prices falling apart, and RBI is talking about inflation pressure building up. Clearly, they'll have to explain what are the factors which they are able to see, which probably we are not able to witness. The third thing is related to growth. You have come down full year growth rate from 7.6 to 7.1. Obviously, bulk of that is happening post 8th of November. And what we have heard from company, because of some amount of backlog, the November month has by and large gone quite normal. So it is December, Jan, Feb and March, the 4 months which are going to bear the brunt. Now, if growth is going to collapse so much in next 4 months as expected by RBI, then why no commitment on liquidity and why not lower interest rates? The only plausible explanation seems to be the global factors. As Maithili was mentioning earlier, maybe the Fed rate behavior, they want to look at it and post that they want to take their call. So we'll have to actually see and listen to what RBI has to say about this contradicting factors between lower growth, lower inflation through consumption destruction, vis-a-vis higher inflation expectation.
Yeah, no, Nilesh, in fact, if you go through the policy release at this juncture and, want Anand's perspective on that, point number 2 is, the concerns on global growth still, not picking up as per expectation. Point number 3, and these are the top points essentially in their assessment analysis. International financial markets were strongly impacted by the result of the US presidential election, and, the upcoming Fed policy meet would also kind of, bring about that differential trade in rates to the fore. So clearly, it's pretty much a given then that global factors have weighed on their decision more than domestic factors. Anand?
Absolutely. So look, I'm a bond trader at heart, and normally I'm thrilled when there's a rate cut, and I'm very sad when there's no rate cut. But today there is a bright side to this. I think the credibility of the RBI and the MPC is restored here, or at least reinforced here. There was a lot of pressure coming in from various quarters, including the industry, for a rate cut here. If the MPC can stand, strong and say this is where we stand, I think it's a great sign for the credibility, and which augurs well for the system. I also agree that rather than rate cuts, what we need is transmission. To that extent, the withdrawal of the special CRR is very good news. I did see a flash coming on your channel, though, that they want liquidity to be made neutral again. If that is indeed the case, then that's a bit of a disappointment. I would have preferred withdrawal of the CRR, but keeping liquidity surplus rather than at neutrality to ensure that transmission happens adequately, at least in the short run. So overall, credibility is strong, a bit of a disappointment. Bond markets will take a bit of a beating in the short run. But with CRR being withdrawn and liquidity measures hopefully following suit, we should see short-end rates remaining soft.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.